Hello everyone, I hope you are all having a great week. My name is Drew, the host of Never Behind, and want to share the insights from well-known investors or investors that have been in the market for a long time with plenty of experiences so that they may provide insights of the market that may help you with your personal investments and never be behind the trends. Today, it is my honor to have one of the best traders in the market, Chris Vermeulen, founder and chief market strategist at thetechnicaltraders.com on the channel. We will be talking about the stages of the markets from euphoria to the market crash stage and share Chris's thought on where the market is at this point in 2023 and what he sees happening in the market in the near future, and also how he is investing his own money to prepare for the upcoming market. Now, I just wanted to make it clear that just because Chris is investing in specific stocks, it doesn't mean that those stocks are the best picks, nor is there any guarantee that these stocks will go up. So please do not follow Chris's or anyone's stock picks without doing your own due diligence. And of course, this is not financial advice, but just sharing insights from a successful investor that has lots of experience in the market and especially went through several market crashes. Now, since the interview lasts much longer than we planned, I have split the interview into two parts and will upload the second half tomorrow. So with that, let's get right into the interview. Oh, and before I get into the interview, I wanted to share that Moomoo is having a great promotion, giving out 16 free stocks, including either Tesla or Google. If you open an account and deposit $100 and keep it in the account for 60 days, you get 5 stocks. And if you deposit $1,000 and keep it for 60 days, you get a total of 15 free stocks. And if you deposit $5,000 and keep it for 60 days, you will get 15 free stocks plus either Google or Tesla stock. So if you want to receive a potential of 16 free stocks, make sure you click the link in the description below. Hello everyone, it is my honor to have Chris Vermeulen, one of the best traders in the market and founder and chief market strategist at thetechnicaltraders.com on our channel today once again. So thank you very much, Chris, for your time today, and it is always great to see you.
Hey, thanks for having me, Andrew. Pleasure to be here.
Right, so let's get right into the market, since I think we are at a very interesting but confusing stage in the market where I see personally two types of investors around me. So one are those that are very excited about the market right now and keep buying the dip as the market fluctuates. And the other group of investors that are, I think, more experienced are very cautious and are not in the stocks, but they buy as many short-term treasury bills or bonds to accumulate high interest rates or, gather more cash. And they actually say that they're comfortable losing the gains in the market that we are seeing right now this year, and would rather wait and accumulate more cash as possible and have it in hand, and are actually still anticipating a very huge market crash. Now, for someone like you who has been in the market for a long time and went through these market cycles, how are you personally seeing the market right now? And do you think that we are actually starting a new long-term bull run, or do you think this is another bull trap that may get a lot of investors in trouble?
Yeah. So you definitely nailed it. There's definitely two extremes of investors. Some of them who want to be really active. They think, we're gung-ho, starting a new bull market. We have been seeing over the past 3 months or so, money piling into those growth stocks, like the ARK ETFs. We got all the tech and small cap kind of growth companies all kind of ripping higher. All the stocks that did really well right after COVID, where everybody was very emotional, piling in, trying to make as much money as they can. Though that group of people seems to be back. And we've been watching that. We've been seeing it start to get a little exhausted, and we've seen a pretty good pullback in the last obviously the last month or so. And it's interesting because on a short-term basis, last week we were talking about it, the put-call ratio, which is a ratio that tells us if majority of people are buying put options or call options. And if you don't know what those are, call options are a way for you to buy a position in the market with lots of leverage. It's really cheap. I look at them like lotto tickets, and you're betting the market to go higher. But if you buy put options, it means you're betting on the market falling and you're putting a bunch of leverage in play. And so last week we had about 5 days almost where the put call ratio closed above 1, which is telling us that the majority of people are buying put options. They're all betting on lower pricing. We saw the VIX pop up to a resistance area. The saying is when the VIX is high, it's time to buy, meaning buy stocks if the VIX is high because people are scared. So over the past week and a half, we've seen everybody sell their stocks. They started to panic. The VIX told us everybody was scared. And then they started buying leverage, betting on lower pricing. And then boom, here, as you and I I speak, we're on, day 3 kind of rally up in the markets, and it's going the opposite direction of the kind of emotional money chasers is what I kind of call them. So that's the one group of people that you kind of nailed. The other group, which I find is very rare actually, are the people who are willing to not get worked up that the market might be rallying a little bit without them. They want to protect their capital. They don't mind making, nice steady returns from treasuries or T-bill notes, things like that, and because they want to protect their capital going forward. And that's the group of people that I really focus on because they actually kind of have their heads screwed on straight. They understand the value of protecting your capital, which means you're protecting your lifestyle, and you're not chasing the money. And that's what usually gets people into trouble, is they try to make as much as they can. They want to they think every move in the market should be traded and caught, and they think they should have huge returns. But that's not the reality. Sometimes it happens, and we do that as well, but it's not a regular occurrence. So where do I see this market? That was kind of a little bit of a rant there. I see the market as retracing up to the recent highs. I think we are in, we are in a bull market phase again. I wouldn't say it's a strong bull market. Money is flowing into growth stocks. We've had a very strong rally this year, but the year started down near the lows after a big cycle low last year. So this is really, to me, a retracement rally going back up to test the highs. So I see the markets in 3 stages. You and I covered this in pretty good detail the last time I was on your show here. And I feel as though we're in this stage 3 topping phase, and it's shaded red because it's a very choppy, difficult time for traders and investors. This is a time where 1 month, a certain group of stocks or sectors are doing really well. The next month they fall out of bed and they sell off. And we're kind of in this kind of rally up, trying to maybe get back up to recent highs. But after this type of stage, we go into a stage 4 decline, which is, to me, is like a real serious bear market. It's like the 2008 financial crisis. It's like the tech bubble in 2001, where it burst and collapsed. Those were stage 4 declines. Those wipe out investors. They take sometimes 5, 10, 15 years for the markets to recover from. And that is what certain groups of individuals want to protect their capital from and potentially profit from these. There's a lot of money that can be made during a stage 4 decline. Prices fall about 7 times faster than they rise. So we can make technically 7 years worth of returns in a 1-year correction, which is very, very exciting. So I think we're in this complacency stage. If we look at it from an emotional standpoint of where investors are, they're in this complacency stage. They think that the sell-off in 2022 was the bear market. They think it's over. They're piling back in, getting into all the same stocks. And if it starts to roll over, they're going to start to have anxiety. They're not going to believe they just bought back into the market near a high, and they're going to panic. And it goes, it just gets really bad until they're depressed and they've lost most of their life savings. And these cycles here are regularly occurring. I've been through these many, many times, and a stage 4 decline could take, it could be 6, 8, 12 months of down strong selling in price. And it could take 3, 5, 15 years to rally back. And, you really need to protect yourself from that. So that's kind of where I see the markets at this point.
So I think that was an interesting point where you said that you think the people that were buying spec stocks are coming back. And do you think that the people that were investing in 2021 when the market exploded is coming back? And do you see the stock market going exponential again and hitting a new time high before the major crash comes?
It very much could. I mean, if we look at the SP 500, we can see here the SP 500. This is the monthly chart. This was the 2022 high. We've been kind of working our way back up for potentially a double top. And we've seen this many times before. The market will push its way higher and hit a nominal new high, just make a new high by a few ticks or a percent or two. And then suddenly, it's headline news. Everybody's like, we're in a bull market, new all-time highs on the indexes. Like, that's literally what sucks the rest of the average investors to pile into the market, to dump their money in, because they're afraid they're going to have FOMO, that they're going to miss out on the next big move. And of course, they all pile in, and it ends up turning into a top, and then huge selling takes place. And the smart money, the inside money, starts unloading their shares to the general public. And of course, they all end up, buying up here near the high. And eventually they'll sell out somewhere at a much lower price. And I mean, we could see a very big correction. We could see a 40, 50+% correction if this was to unfold.
Okay, so Chris, I had actually 2 questions after listening to what you just said. But But first of all, you said that the market could go down. When it falls, it could go down like 7 times faster than it went up. And my first question is, in that scenario, how are you preparing? So are you, buying put options or are you buying inverse ETFs? And was wondering what your thoughts were on that. And then the second part is I know that a lot of people, because of the internet, know about the market cycle. YouTubers talk about that. So they actually know that the market might go up before it has a major crash. But I think it's at a point where a lot of people, although they know it, they can't stand it and it feels like they have to pile money into it. And is this something that happens before a major crash actually occurs based on your past history or experiences?
Yeah. So to answer both the questions, first one was how do we take advantage of falling prices? So the stock market typically falls like 4 to 7 times faster, meaning it doesn't matter what you trade. I'm just saying if it takes 7 years to go up, it can fall and wipe out 7 years of gains or 7 bars on the chart in one bar, 1 or 2 bars. So prices always just drop a lot faster than they go up. So knowing that, I trade, if we get into a stage 4 decline, which is the only time I buy inverse ETFs, we need to be in like a full-on bear market. That's when I buy an inverse ETF. I don't use any leveraged ETFs, although a lot of people will trade leveraged based around like signals that I share. But I just stick with the straight up one-time inverse ETF of the index or bonds, whatever it is we want to trade. So that's how I attack that. In terms of answering your question with, does everybody need to pile in before, the market rolls over? Typically, yes. And that's what we've actually been starting to see. I mentioned it earlier. In the last 3 months, we're starting to see people have FOMO and they're running towards the market. They're buying the growth in the tech companies that did really well the last time they made a bunch of money. I mean, most people actually gave it back when it comes to the growth stocks. Actually, there's a really good chart. So let me just show you something kind of interesting here. So ARKK is an ETF that everyone piled in after COVID. It had massive returns, went up hundreds of percent. This is where like everybody piled in. This is tech growth companies. And a lot of people made a ton of money, or they were, making a lot of money. Unfortunately, they never held it and it wiped out all those gains and it's back down near those lows. Well, the people who piled into this they're piling back into it again. Now, there's been a lot of damage to this, but overall, if you were to just look at this chart, this is, the stage analysis. You've got a stage 1 base, stage 2, you had a blow off phase. It sold down, it consolidated. People thought that was the bottom, and then the bottom fell out and it's back into a stage 1. So this type of stock, these particular ARK ETFs, if we were to flip to the daily chart, these ones have had very, very strong runs in the last little while. And of course, are the ones that also just got hit the hardest because it's a very emotional, very fast moving group of stocks and traders who pile in and then they run and bail out of them. And so we are seeing money rotate back into these stocks. But as you can see, it can take 1, 2, 3 months to go up. And I mean, it wiped out most of it in less than a month. We're only halfway through a month. So we are starting to see waves of money of these, of the general masses coming in. But I do think we probably still need to see another push higher. And I think it's going to suck in the majority of investors still sitting on the sidelines who can't stomach watching the market rally without them. So yes, the market needs to try to suck in as many people as possible to get them on the wrong side before it's going to, I think, sell off.